the current issues with U.S. trade specifically are heavily tied to the global monetary system as it's structured. So going back to my point that every several decades these things tend to change pretty substantially. This is potentially more than just a trade cycle. Part of why so many entities even talking about a monetary change or a change in structure is because it's so tied to trade. And a point that I've made is that basically the other side of being the global reserve currency is something in your economy is generally getting hollowed out. We are gradually hollowing out our industrial base to maintain our kind of global dollar empire. I think that historically we go through certain monetary changes. There are a couple different cycles that kind of overlap. One of them could be considered the long-term debt cycle. So debt builds up in the private sector, then generally gets transferred more toward the sovereign level, and then gets basically debased or inflated away. That's kind of one big cycle that developed economies go through in modern history on something like an 80-year cadence, but it can vary. And then just more broadly, there's this kind of imbalances that build up in any sort of complex system, the way that these are currently constructed. And so even between those, say, 80-year periods, there's usually like a midpoint where things change. So for example, the midpoint between the past kind of long-term debt cycle, which was the 30s and 40s, and the current one was the early 1970s. That was a different type of default, a different type of monetary change. And so I agree with you that this is kind of a historic moment. I don't know if there's a specific date that's going to stand out to quite the same way. Maybe Liberation Day, maybe another time what we pick, maybe the moment that Russia invaded Ukraine, and then there are all these sanctions triggered. That maybe it's just the pandemic itself that was kind of a catalyst for a lot of things as well, fiscally speaking. So I don't know exactly what date or period will be highlighted as like the points, but I do think that this era will be looked back upon, much like the 70s, much like the 30s and 40s, as a time of change in the way that the global monetary system is constructed, and the way that a lot of domestic finances work. I generally put something like the Plaza Accord on a smaller level than the bigger things I mentioned, because that was more of like a pivot point within a current structure. So that wasn't really like the foundation shifting. That was more like a bunch of entities agreeing to kind of keep that system going. Because otherwise, that's the system that we've been in since the 70s could have broken earlier had certain things become totally unbounded. And that was one of the kind of events that kind of kept it going, kept it kind of sustainable, for lack of a better word, or at least longer sustained. And I do think that the something like a Mar-a-Lago Accord could absolutely occur here. If you look back to the early 1970s, when this current kind of floating exchange rate system really began, there's really only been $3 cycles. So major periods of dollar strengthening compared to other currencies and then weakening compared to other currencies. These have had very big investing implications each time. Generally speaking, when you have this kind of weaker dollar periods, you're looking at more inflationary periods, you're looking at more value stock outperformance periods, you're looking at more international stock outperformance periods. Whereas when you're looking at the stronger dollar periods, you're generally looking at more disinflation, you're looking at more growth stock outperformance, you're looking at more U.S. stock outperformance. And so, we have been in a strong dollar environment for quite a while now, since about 2014. So we're something like 11 years in what is a fairly strong dollar environment. And should we get another leg lower in the dollar, either just due to policy flow shifts, kind of like, say, the early 2000s dollar bear cycle, or a more intentional dollar bear cycle like 1985, the Plaza Accord, we could have a Mar-a-Lago Accord. That has a variety of major investing implications, but it's not necessarily a structural change in how the system works. So I do think that we could certainly be geared toward something more than just that, because some of the things have been building up for a lot longer than just, say, a dollar cycle. But that is kind of a one key thing to watch for any of us that are involved in markets or follow the prices of assets we own. So that is a key thing to watch. I mean, if you look at the $3 cycles of modern history, each one is kind of a lower high than the prior one thus far. So even though, like you said, it's not as high as 1985, it's a different world than it was back then. And so the system starts to kind of break at a lower high than it used to. Back in the 1980s, there's both in the US and elsewhere, there's a lot less debt in the system. And so it could go a lot further before it would run into problems. Whereas now the feedback loop is a lot tighter. And so it runs into issues sooner. So yeah, ever since 2014, roughly coincided with the end of QE3, quantitative easing three, the third round after the global financial crisis. When that ended, we had a pretty strong dollar surge. And although it's fluctuated, it goes up to say at 100 on the dollar index. It's gotten as high as like 114. It's gotten down. So it goes through these kind of waves in this period. But during that 11-year stretch, it's all been pretty elevated. And we look at it on a trade balance basis, it's very strong. When you look at its effects on, what type of assets are doing well, what types of economies are booming or not booming, it's all characteristic of a stronger dollar environment. Generally, when you get a truly weaker dollar move, you'll get something like an emerging markets boom for maybe 3 to 5 years. You'll get probably a round of inflation. You'll probably get a round of kind of value stock outperformance. We've not really seen any of that at scale. Sometimes you have individual years of that happening. For example, 2017 was a good kind of rotation year for those types of assets. This year so far has been somewhat of a rotation year, but these are kind of smaller moves compared to what you can get when you have a true, say, 20-30% currency shift involving the dollar.
And then when you see these big shifts happen in the dollar, going back into a weaker dollar, then that tends to correlate with like global M2 increasing. So the money supply starts increasing when that goes down, and that's also part of what pushes these other markets back up.
Yes, indirectly, because many cases, global M2 will be measured in dollars because global M2 has a bunch of different units, all the different units of the major currencies. And so when you're kind of reporting what is the value of this figure, it's normally reported in dollar equivalents because that's the global reserve currency. And the reason it's really relevant is because out of all the major currencies, the dollar is by far the most important cross-border funding currency. So there's something like $18 trillion worth of dollar-denominated loans and bonds that are cross-border in the world. And so it's the unit of account for liabilities, which is really important. So when the dollar is weakening, it means various entities around the world, their liabilities are weakening, which is good for them. Whereas when the dollar is strengthening, their liabilities are hardening. It's like if you took out a mortgage in Swiss francs, but say you're renting it out and all the cash flows are in dollars, you're in a world of pain if the Swiss franc doubles compared to the dollar, whereas you're doing great if the Swiss franc gets cut in half relative to the dollar. And so that's what happens kind of the whole world. And so whenever you do get that weaker dollar environment, yeah, you get a surge in global M2, but it's mainly because the denominator is going down. But then also what that does is that allows emerging market central banks around the world to kind of loosen a little bit. Because during strong dollar environments, even if they encounter a recession, they often have to be pretty tight with their monetary policy to avoid currency crises. And so when they do get that weaker dollar period, they're able to kind of actually stimulate for a change. And that's when we tend to get that little bit of a rotation.
Yeah.
I think what they want more is like higher capital goods. Even when we look at China, for example, that's the trade boogeyman at the current time. They've moved up the capital stack. So we used to think of China as the biggest producer of like plastic goods, for example, and textiles. A lot of that has rotated toward less expensive manufacturing places than China, whereas they've moved up the capital stack. China is now the biggest exporter of vehicles in the world. They've passed South Korea, Germany, and Japan as the biggest exporter. And it's not just, like electric vehicles, it's actually mostly ICE vehicles. Like when I go bring up Egypt again, the streets just have tons of Chinese cars on them. And that's true for a lot of our developing countries in the world. We don't see them in the US, but you see them in a lot of other places. And I think, several entities in the US kind of want that for the US. They want to be a semiconductor manufacturing area. We want to be leaders in robotics. We want to be a leader in all sorts of kind of higher end capital goods, rather than kind of give that industry up to Europe and East Asia and places like that. And I do think it's bigger than just trade, because a point that I've been making a lot is that the current issues with U.S. trade specifically are heavily tied to the global monetary system as it's structured. So going back to my point that every several decades, these things tend to change pretty substantially. This is potentially more than just a trade cycle. Part of why so many entities even talking about a monetary change or a change in structure is because it's so tied to trade. And a point that I've made is that basically the other side of being the global reserve currency is something in your economy is generally getting hollowed out. There's some sort of imbalance that's kind of embedded into the system, and you're kind of paying this cost to maintain the privilege of being the global reserve currency. So back in the Bretton Woods era, the cost was that we were draining our gold reserves. We had pegged the dollar to gold. A bunch of other currencies pegged themselves to the dollar, and then the dollar was the primary global funding currency. So the combination of fractional reserve banks and deficit spending made it so that the number of dollars kept increasing dramatically, but our gold reserves were not.
Right.
And so over time, as you get more foreign redemptions, our gold reserves fell from 20,000 tons to 9,000 tons, and then they quickly defaulted on the ability to redeem dollars for gold. And ever since then, when we shifted more toward the euro dollar system, petrodollar system, instead, kind of the cost that we're paying is deindustrialization. We are gradually hollowing out our industrial base to maintain our kind of global dollar empire. But this has cumulative imbalances. We're constantly taking away from Michigan and Ohio and Pennsylvania and the Rust Belt and making it get the name Rust Belt. It's going then international, and then they're reinvesting their proceeds in U.S. stocks, U.S. bonds, private equity. So that's going back into New York, back into Silicon Valley. And so kind of the net result is we're taking out of the Midwest and we're sticking the value into the coasts. And so you get both domestic political issues, and then you get these kind of global big imbalances where China has all these massive surpluses, the U.S. has all these massive deficits, and other countries kind of sit somewhere in the middle. And that's kind of an artifact of the system that we've structured. And the challenge is that if you want to bring back some degree of manufacturing and industrial vibrancy, it generally comes with the cost of giving up some degree of the currency power that they have.
We now make digital products. We make Facebook and social media platforms and financial products, and those get exported to the world, and the world imports those, and that doesn't show up in trade balance, does it?
Yeah, so two questions. One is actually it does.
Oh, it does.
So there is a services component to trade balance. And our trade balance as reported includes services. We actually have a services surplus, to your point. And services can also include things like tourism. If a place doesn't really export things, but everyone wants to go there to travel, yeah, and they bring currency with them and they spend in that economy, they're basically exporting tourism services, is the way to think about it. So the U.S. is exporting financial services, software services, tourism services, things like that. And that is taking away from some of our goods deficit, but we still have a net deficit even after that's considered. And it's pretty big. And to your point, like specialization matters. Like the trade is a net good because it allows different areas to focus. It only becomes an issue when it's not necessarily happening naturally. It's happening because of an artifact of basically an intentional system as designed. And two, there's usually real politics at some point that hits. There's national security interests that hit. And so, for example, when a pandemic hits and they're like, wait a second, we can't make ventilators.
Yeah.
Why can't we make ventilators?
Right.
Or semiconductors are super important. Why are all the semiconductors being made in like Taiwan and South Korea, right, for example? That becomes an issue. So people usually don't lose sleep over where shirts are made, but they do lose sleep over where complex machinery is made, especially if it's a handful of kind of places in the world. Yeah. So, and there's a weird thing you don't think about, like pharmaceutical components, medical dyes that are needed in like imaging, just little widgets here and there that our industry is just heavily reliant on. And if you do have some sort of trade embargo, you can have a national security issue and kind of shortages, yeah, and things like that. So if you look at, for example, that Stephen Myron paper, so Stephen Myron is Trump's chair of the Council of Economic Advisors to the president. Yep. And he kind of outlined that the trade imbalance is directly tied to the currency issue, and that there is somewhat of a trade-off there. One of the challenges that I think the administration, as they're approaching it, is not really talking about that other side of it. They want to retain every single benefit of the dollar as the global reserve currency, but then they also want to fix the trade element, even though they're kind of tied at the hip.
Right.
And I think that's where they potentially run into frictions, because it's more like you're treating a series of symptoms rather than talking about the elephant in the room, which is kind of the root cause, because it's very wonky to talk about. It's not something like all the stuff I just said is terrible at a political rally. It's not, no one's going to clap. It's not fun. It's not energizing. There's no enemy. It's like, it's cumulative decisions that us and others have made collaboratively for decades.
Right.
And so that's the challenge. And there's no kind of narrative political gain from saying we're actually being harmed by being the sole reserve currency now, that the downsides of it are kind of equal or exceeding the benefits of being it. Um, and it's a whole wonky subject to talk about. It's more about we're in a more multipolar world now, and there are realities associated with that. But yeah, none of that carries political capital to bring up. And so it's a lot of the focus is on the tariff side, the trade side, but the challenge being that's only one side of the coin.
Yeah.
Welcome to the Deep Dive. I'm really thrilled you're joining us today for episode 32 of the Market Chronicles. Here we try to cut through all the noise, really understand the big forces shaping our global economy. And today we're looking at something quite profound, almost a paradox, you could say, how the immense privilege of the US dollar's global status might actually be its Achilles heel, and how that subtly shapes, well, everything from your investment portfolio right through to geopolitical stability. Oh, and if you happen to be watching on YouTube, please do hit that subscribe button for more deep dives like this one.
Yeah, what's truly fascinating, I think, is how all these seemingly separate things are actually deeply connected. We're going to dive into let's say, a nuanced look at the U.S. dollar's role, its really pivotal role, and these persistent global trade imbalances it tends to create, plus what these historical cycles mean for investment and policy decisions right now, today. It's really about connecting the dots, looking at past patterns and seeing how they play out in the present.
It definitely feels like the global financial system is maybe on the cusp of something significant, doesn't it? And you're saying our current issues, like with U.S. trade, they're really tangled up with the whole structure, the global monetary system itself. So this isn't just another trade cycle we're seeing. It could be something more fundamental. You mentioned these kinds of transformations. They tend to happen, every few decades, and pretty substantially.
Indeed, yes. And a core concept to really get your head around is that being the global reserve currency, I mean, it's an immense privilege, no doubt, but it inherently comes with usually a significant and often kind of invisible cost. Historically, it means some vital part of your economy often gets, hollowed out. Think back to the Bretton Woods era. The cost then, it was literally draining our gold reserves. As more dollars were printed than we actually had gold backing them, our reserves just plummeted. Went from like 20,000 tons down to maybe 9,000 tons, which eventually forced the default on gold redemption.
Wow. Okay. So a real tangible asset, gold, that was the price back then. What's the equivalent hollowing out that we're experiencing now, especially since we shifted, after the 70s to the Eurodollar system?
Yeah, good question. Since that big transition, the main cost has really been deindustrialization. To maintain what some people call our global dollar empire, we've effectively been gradually eroding our own domestic industrial base. And this process, unfortunately, it transfers huge amounts of value from those traditional manufacturing areas. The Rust Belt,
Michigan, Ohio?
Exactly. Michigan, Ohio, Pennsylvania, place like that, over to the coastal financial and tech hubs, think New York, Silicon Valley. And the direct result of that, you get two big things. Significant domestic political friction, which I think we've all clearly seen recently, and these massive global imbalances, like consistent trade surpluses in places like China, and these persistent deficits right here in the U.S. It's an inherent feature, really, an artifact of the system we've built to maintain.
That really paints a clear picture how those global dynamics create very real pressures right here at home.
Okay, so let's shift gears slightly and explore the dollar's specific cycles, because this is where I think we see the really direct market impacts. You mentioned since the early 70s, when the floating exchange rate system really kicked off, we've seen about 3 major dollar cycles. And each one had, you said, very significant investing implications.
Precisely. Yeah, we can sort of map out distinct characteristics for strong dollar periods versus weak dollar periods. So, for example, strong dollar periods, which we've largely been in since about 2014, give or take, they typically bring things like disinflation. You see growth stocks doing particularly well, and just general strength in U.S. equities overall. We've been in a fairly robust dollar environment for something like 11 years now. It roughly coincided with the end of QE3, quantitative easing 3. Okay, so for over a decade, certain market trends have been kind of reliably linked to this strong dollar. What about the other side of that coin then? What shifts might investors expect during a weak dollar period? And why do they tend to, foster different market leadership?
Right. Weak dollar periods, they tend to usher in more inflationary type environments. They usually favor value stock outperformance and often give a significant boost to international equities. You quite often see an emerging markets boom, maybe lasting for, say, 3 to 5 years. Now, we haven't really seen these at scale recently. I mean, there were some individual years, like 2017, showed some brief rotations maybe.
Right.
But a truly weak dollar shift, that can be profoundly impactful for markets. There's also this concept floating around, maybe a potential Mar-a-Lago Accord,
Interesting.
which would basically describe an intentional, policy-driven dollar bear cycle, sort of like the 1985 Plaza Accord in spirit.
Yeah.
Now, that would certainly have major investing implications, yeah. But importantly, it wouldn't necessarily mean a structural change in how the whole global system fundamentally works.
That's a really crucial distinction, isn't it? A big market event versus a foundational shift in the system itself. Okay, so given these dollar cycles, what do they tell us about the current state of global debt? And how does that maybe influence how quickly problems seem to emerge these days?
Yeah, connecting it to the bigger picture, it's quite notable that these three big dollar cycles in the modern era, they've consistently shown a lower high than the previous one, which kind of suggests a tighter feedback loop in the system now. Problems start to surface, well, much sooner than they used to.
Yeah.
If you go back to the 1980s, both here in the U.S. and globally, there was just significantly less debt overall in the system.
Right. More wiggle room.
Exactly. More flexibility
Yeah.
before issues really started to pile up. But now, the sheer amount of cumulative debt, it just amplifies the effects, meaning we hit these pressure points much, much more rapidly.
That tighter feedback loop, yeah, that certainly accelerates things, makes the stakes higher faster. You also mentioned that when the dollar weakens, something called global M2, the money supply measured in dollars tends to go up. Could you maybe unpack the mechanism behind that? How does that work, and what's the global impact?
Sure. This mechanism is pretty central to understanding how global liquidity flows. See, global M2 is often measured in dollars simply because the dollar is the main unit of account for cross-border liabilities. We're talking about a huge number, roughly 18 trillion worth of dollar-denominated loans and bonds held across different borders.
Wow, 18 trillion.
Yeah, it's massive. So when the dollar weakens, it effectively just reduces the burden of these dollar debts for foreign entities. It's kind of like, imagine you're a borrower, your income's in one currency, but your big loan is in dollars. If your local currency gets stronger against the dollar, suddenly that debt becomes easier to service, right?
Makes sense.
So this apparent surge in global M2 isn't always, new money being printed everywhere. A lot of it is just because the denominator, the dollar itself, is getting cheaper. But critically, what this does is it allows emerging market central banks around the world to kind of loosen their own monetary policy a bit. See, during strong dollar periods, even if their own economy is struggling, in a recession maybe, they often have to keep policy tight. Why? To prevent a currency crisis.
Right, defending the currency.
Exactly. So a weaker dollar period gives them that breathing room, that's the space, to actually stimulate their economies. And that, in turn, tends to drive the kind of investment rotation that we talked about earlier.
This leads us right into policy, doesn't it? And the whole political landscape surrounding it. There seems to be this strong desire in the U.S. now to move up the capital stack in manufacturing, focusing on higher value stuff. We've seen China make that leap, right? They're not just textiles anymore. They're now the biggest exporter of vehicles globally.
Yeah, it's incredible.
Past South Korea, Germany, Japan. Millions of cars, both old-style combustion engines and EVs. So the U.S. wants leadership in things like, say, semiconductor manufacturing, robotics, other high-end capital goods.
And this brings us right to a really fundamental trade-off. And it's one that's, frankly, politically very difficult to address at its roots.
Right.
Yes, the U.S. does have a services surplus. We export financial services, software, tourism, things like that.
Right.
But we still run a pretty significant net trade deficit overall when you factor in physical goods. And the core issue really pops up when those vital goods become national security concerns.
Yeah.
Think about needing ventilators during a pandemic or the absolute critical importance of semiconductors,
Yeah.
most of which are currently made in Taiwan, South Korea, mainly. So relying so heavily on foreign production for those essentials, well, it clearly becomes a national security vulnerability. And that trade imbalance, this is the key point, it's directly tied to the currency issue. They're linked.
Okay, so the policy puzzle then is that administrations seem to want all the benefits of the dollar being the reserve currency, but they also want to fix the trade deficits, which, as you're saying, are arguably a direct consequence of that very status. Is it just too politically difficult to wonky, maybe, to tackle the underlying cause?
Absolutely. That's exactly the challenge for policymakers, talking about the root cause, the actual structure of the global monetary system and its inherent trade-offs. It's incredibly complex. And let's be honest, it's pretty wonky, as you said. It's not exactly a topic that wins votes or uh, energizes a political base.
Not great on a bumper sticker.
Not at all. There's no clear enemy to point fingers at, because this situation is the result, the cumulative result of decisions made collaboratively by the U.S., by other nations over decades and decades. So there's basically no narrative political gain from standing up and saying, hey, maybe we're actually being harmed now by being the sole reserve currency. You know, maybe the downsides are starting to equal or even outweigh the benefits. It's a really complex, nuanced discussion about operating in a world that's becoming more multipolar. So instead, what happens? The political focus stays largely on the tariff side, right? The trade side of the equation. It's much more tangible, politically speaking. But the fundamental challenge remains. That's only addressing one side of the coin. You arguably can't truly fix a trade imbalance without grappling with the dollar's unique central role. It's the kind of knotty problem that keeps economists up at night and, probably makes most dinner-party conversations go quiet pretty quickly.
Well, this deep dive has certainly revealed just how tightly connected all these global forces really are. It seems crystal clear that the U.S. dollar's status as the global reserve currency, these persistent trade imbalances we see, and those impactful dollar cycles, they're all tangled together. And they influence just about everything, from big national security questions right down to the performance of, your own investment portfolio. It really does feel like we're living through a truly historic moment, maybe comparable to those huge shifts back in the 1930s and 40s, or perhaps in the 1970s. We might be witnessing a really fundamental change in how the whole global monetary system is actually put together.
And that raises, I think, a really important question for all of us going forward. How will future policymakers actually try to grapple with this inherent trade-off, this tension? Because recognizing this very intricate but absolutely critical link between currency power and trade realities, well, that's essential. It's essential if you truly want to understand the current global economic landscape. The temptation will always be there to just focus on the politically easier solutions, things like tariffs, rather than addressing the much harder structural issues that come with being the sole reserve currency. Focusing only on trade leaves us with really only a partial view of the picture. It's definitely something for all of us to continue to think about, to mull over as these global dynamics keep unfolding.